The housing market continues sending mixed signals as builders pulled back on construction, but pending home sales beat expectations for the third straight month, showing buyers are still active despite higher rates. Meanwhile, the Fed remains divided on how to handle stubborn inflation and signs of a slowing economy. Good afternoon. I hope you had a wonderful Memorial Day weekend spent with friends and family. I want to take a quick moment to thank all the servicemen and women out there that have paid the ultimate sacrifice for the freedoms that we enjoy today. It's always important to remember the true meaning behind the holiday and why we honor it. Now, as we head toward the end of May, last week brought another round of major headlines and market volatility that definitely impacted mortgage rates. Like we talked about last week, mortgage rates tend to follow inflation expectations very closely. So, anytime the market receives news that could potentially push inflation higher, rates usually react pretty quickly. As you know from listening to me, the main theme investors are watching is oil prices and how the situation involving the US and Iran continue to unfold. Toward the end of last week, there was some optimism that a legitimate peace deal may have been coming together, which helped push oil prices lower to the $90 range per barrel, while the 10-year Treasury improved to around 4.48% as the market opened. That said, I think investors are still being very cautious right now. We've already seen several situations where potential deals appeared close, only to fall apart and send the markets right back into volatility mode. So now the big question becomes whether tensions continue easing this week and if we start seeing some relief in mortgage rates as a result. Here are your headlines. Now, in housing news, housing data continues showing just how cautious both builders and buyers are becoming in this market. Housing starts fell nearly 3% from March to April, driven mostly by a slowdown in single-family construction as builders continue navigating higher mortgage rates, affordability challenges, and broader economic uncertainty. At the same time, builder confidence actually improved slightly in May, which tells me builders are still believing that demand is out there, but they're being much more careful and strategic about how aggressively they move forward right now. Higher mortgage rates, rising fuel costs, and continued uncertainty surrounding inflation and the economy are still creating pressure on the housing market overall. So, what is the bigger picture? This means that strategy continues to be more important than ever. Buyers are still active, but affordability remains the biggest challenge, which is creating more opportunities for negotiations, seller concessions, and rate buydowns compared to the ultra competitive market we saw a few years ago. For realtors, this is a market where education and proper expectations matter. Homes that are priced correctly and marketed well are still moving, but buyers are being much more payment conscious and cautious with their decisions. For consumers, this means there are still opportunities out there, especially with more inventory slowly coming back to the market, but having the right game plan and financing strategy can make a huge difference. Now, pending home sales increased 1.4% in April, beating expectations and marking the third straight month of gains, which continues showing that buyers are still active despite higher mortgage rates and affordability challenges. Sales were also up 3.2% compared to last year, with the strongest activity coming from the Northeast and Midwest. Personally, I think this is another sign that demand hasn't disappeared. Buyers have simply become much more cautious and payment focused compared to the frenzy we saw a few years ago, like I mentioned earlier. Many buyers are still waiting and watching rates closely, but there's clearly still demand in the market whenever affordability improves, even slightly. For buyers, this means competition has eased compared to previous years, but opportunities still exist for those who are financially prepared and have the right strategy in place. We are continuing to see more flexibility from sellers, and that creates more opportunities for buyers. The bigger picture is that the housing market continues showing resilience even in a much tougher rate environment. Demand is still there, but affordability remains the biggest hurdle. If mortgage rates improve later this year, I think we could see a noticeable increase in buyer activity fairly quickly because there is still a large amount of pent-up demand sitting on the sidelines right now. Now, in the latest Federal Reserve meeting, minutes showed that there is still a pretty major divide among policymakers regarding whether interest rates may go from here. While the Fed ultimately left rates unchanged as expected, some members are already pushing for a rate cut if the labor market weakens further, while others believe additional rate hikes could still be necessary if inflation remains stubbornly above the Fed's 2% target. Personally, I think this continues showing just how difficult the Fed's position is right now. Inflation is running hotter than they would like, but at the same time, there are still growing signs the economy may be slowing underneath the surface. With the continued announcements of layoffs tied to AI infrastructure and automation, we could be entering an interesting environment where inflation remains sticky, parts of the labor market continue weakening, but the overall economy stays relatively resilient because of the efficiency and productivity gains being created through AI. Add in the uncertainty surrounding oil prices, global tensions, and the transition to Kevin Warsh as the new Fed chair, and it's easy to see why the markets have remained so volatile lately. This week should give the market plenty to digest following Monday's Memorial Day closure. Housing data remains in focus with home price reports from Case-Shiller and FHFA this morning, followed by new home sales on Thursday. Thursday will also be likely the biggest day of the week as investors react to the latest GDP revision, jobless claims data, and more importantly, the personal consumption expenditures, or PCE, which is the Federal Reserve's preferred inflation gauge. At this point, the market is still searching for a direction, and until we get more clarity on inflation and the broader economy, mortgage rates will likely continue reacting aggressively to major headlines and economic reports. We'll have to see what this week brings for mortgage rates, but for now, I hope you have a good rest of your day.